Hey everyone, welcome back. Today we're going to talk about one of the biggest financial challenges in retirement, and that is that when you quit working, your paychecks will stop, but your bills won't. So housing, utilities, groceries, these are all things that you're going to need to continue to pay for even after work stops paying you. And the question is, how do you create an income stream that will keep paying these bills and last as long as you do in retirement? This is an important question. It's the cornerstone of a great retirement strategy. And today we're going to look at two options that are really popular to solve this problem: bonds and dividend stocks. Both promise to provide you reliable income, but they do it in two very different ways. Understanding the difference between the two is important in having a successful retirement. So let's start with bonds. They're essentially an IOU. You can think of it as being the bank. You're lending your money to a company or a government, and in exchange, they're promising to pay you back the original money plus some interest over a set period of time. Now, the biggest selling point with bonds is safety. You know exactly what you're getting, and you know exactly when. And that's great for, someone that's very low risk and needs stability in their portfolio. That's why they're often recommended for investors nearing retirement, because of the safety and the stability that they provide. So while the safety and stability of bonds is appealing, it does have a few problems. And the major one is that your principal and your interest payments don't grow. So if you loan out $10,000 at 5% interest and you're getting $500 a year, that's what you're going to get for the duration of the bond. And that $500 a year may help you purchase some things at the beginning of that period, but if you think about it, in 10 years' time, what that $500 is going to purchase is going to be less. The cost of everything tends to go up over time. And the same is true for that $10,000 principal. You'll get the $10,000 back in 10 years, but what it will purchase will be less than when you loaned it out. So of course, what I'm talking about here is inflation, and bonds offer no protection against rising costs of living. So what's the alternative? How can you get an income stream that goes up over time to keep up with inflation? Well, a great answer, at least in my view, is dividend growth stocks. Now, these are companies that do pay a dividend, but also have a long history of consistent raises in that dividend. And these are typically well-established companies with strong business models that generate a lot of cash flow. And not only do we want a history of growing dividends, we also want the future of the company to look bright so that they can continue to grow those dividends and keep paying us more and more each year to fight inflation. So this gives you two great benefits. First is that your principal has the opportunity to grow. As these companies tend to grow their profits and their earnings and their dividends, the stock prices tend to follow. So the money that you invest initially to get your dividend company, that principal will probably be worth more 10, 15, 20 years down the road, as long as the company has continued to grow. And second, your dividend payment tends to continue to grow along with the company and the profits and the cash flows. So the dividend check you get this year tends to be bigger than the one you got last year, and the one you get next year is probably going to be bigger than the one that you got this year. That helps you fight inflation, and many of these companies tend to beat it. If we look at these companies that have raised their dividends for a long period, we can see some pretty interesting trends. First, if we look at the dividend aristocrats, these are S&P 500 companies that have raised their dividends for at least 25 years in a row, we can see that that index tends to outperform the market. And then there's a second group, companies like Coca-Cola, that are dividend kings. Now, these are companies that have raised their dividends for at least 50 years in a row. And if we look at Coca-Cola's dividend per share growth over a long period, we can see that it tends to outpace inflation. Now, before you go and sell all your bonds and buy dividend growth stocks, you do need to know that it doesn't come without risk. First, there's the risk of stock price volatility. These are stocks, these are companies priced in the stock market, and the prices can fluctuate, sometimes widely. Now, this isn't a problem as long as you buy good companies that tend to grow. Eventually, the stock price catches up to the business and the stock price goes up along with the value of the business, but there's always the risk that the business doesn't do well and the stock price goes down. The other risk is that if you need this money in the short run, if the stock price goes down when you need the money, that's a problem. So these aren't investments suitable for money that you're going to need very quickly. The second risk is that the dividends, while they have a history of growth, that's not guaranteed. These companies can stop growing their dividends or even cut them altogether if the business runs into trouble and doesn't do well. So the income can grow, but it's also not quite as guaranteed as the income from, say, a bond. So to sum it all up, bonds offer stability and predictability. That's why they're called fixed income investments, but they are susceptible to inflation. While dividend growth stocks offer you the potential to grow both your income and your principal, but they are subject to volatility and come with the potential of dividend cuts. So it doesn't necessarily have to be one or the other. A lot of investors mix the two strategies. They have a base of bonds for stability and predictability, and then they layer on top some dividend growth stocks for potential for growth and to fight inflation. So what do you think? Are you a dividend investor, a bond investor? Do you mix the two? I'm curious. Let me know in the comments. Thanks for watching. Hope this was helpful, and we'll see you in the next one.